So let's bring in Alex Coffey on that note, co-host of Next Gen Investing. And what levels are you watching this morning? Alex, seems like a little bit of a recovery underway after that initial sell-off that we saw yesterday.
Yeah, I mean, if that's the bear move, bulls got to feel pretty good about where things sit. Obviously, it's very early in the week. We know it's a week that's going to be very headline-driven, as we talked about yesterday, Sam, and it proved to be that way yesterday, as it was a very quiet session that saw volatility wake up with some of those trade announcements that we got. If we could pull up the first chart I sent over, it's an intraday look at the S&P 500 using the same system that we talked about yesterday. Just for kind of a visual awareness, I like to use sort of this stoplight system. Resistance in red, sort of the neutral balance point line, and the yellow, the slow down kind of line, and then green as potential support, much like you see with a traffic light. Yesterday, the 6250 line was, one of the lines in the sand that we watched, and that broke early in the session. And then we spent most of the day hanging around 6225, which of course is that yellow line. The lows of yesterday's session were just above 6200. To me, that's the line in the sand that bulls want to make sure holds at the very lowest here intraday for the S&P 500. Now, that's about 31 points below where we are right now. So it would be about a 0.5% sell-off for us to get back down to yesterday's lows. And of course, you have that sort of balance point in the middle that could act as some short-term, near-term support here intraday around 6225.
Speaking to Bob Lang yesterday, who sort of suggested that it's not surprising to see a bit of a mild correction, particularly heading into an earnings season, which is just around the corner. And of course, there has been some people sort of describing what we saw yesterday as just pure exhaustion, not putting it really down to any reason right now. But then I've also seen out from the folks at Goldman Sachs now raising their S&P 500 valuation and return forecast. They're looking at 12-month period, up 11%, 6,900. What sort of trends are you seeing right now in the S&P 500?
Yeah, it's a good question because you read so much, Sam, about how hated this rally's been and how it's been very retail driven and institutions haven't participated to the same extent. And the big question is, what does that mean? Does that mean that we're due for some sort of pullback? Possibly, but does it also mean that institutions are going to look for any opportunity to get back in? This is the last 3 months of the S&P 500, which essentially is the rally from the lows conveniently. What I see is a trend that is still very much a bullish one and very much intact. For a very short-term indicator, something that's quite simple to add to a chart and think about is the relationship between a 1-week or 5-day EMA and a 1-month or 21-day EMA. I talked about how if this was a little bit larger chart, it would have shown a crossover in late February of this year in which the 1 week went below the 1 month. If you just use that as your only indicator, it would have kept you out of the market, basically avoiding the whole drawdown until April 25th. Yeah, so you would have missed a little bit of the early parts of the recovery, but would have got you out around 6,000 and would have got you back in around 5,400. Since it's crossed back over on the April 25th or late April, it has not gone back into that bearish formation. So still a very bullish trend just by that indicator. We're above both of those lines when you're looking at the S&P 500. Also right now, conveniently, the 1 week EMA does line up with that yellow line that we talked about on that intraday chart. And then also, if we have that longer term trend look again for the S&P 500, two momentum indicators both still indicate pretty strong momentum, although the RSI has dipped back into that bound below 70. So if you're looking at that, you could say, hey, we are starting to cool off a little bit, but we did spend quite a few sessions in that overbought territory, which isn't a bad thing, but maybe we were due for a little bit of a correction.
No doubt about it. And, you talk about all these moving parts for the markets. Obviously, we're waiting to see what or what not the Fed might do. And also when it comes to some of these negotiations around this new extended deadline with the tariffs, no doubt people are keeping tabs on the big, beautiful bill as well, how that's actually going to work its way through the system. And I mean, some would argue that that is a recipe for volatility. But is that what you're seeing?
Yeah, it's interesting. It's a unique picture that's being painted right now, Sam. You know, Marley Caden on Market on Close, I think, used the right word yesterday, which is this word of complacency. But I'm not sure that it paints the full picture. It certainly paints the picture of right now, but you talked about the fiscal policy. We know there's geopolitical tensions. We know there's uncertainty when it comes to trade policy. Also, earnings estimates haven't exactly been ramping up. If anything, they've been coming down. This is volatility over that same 3-month time frame, and it's painting a very different picture, right? It's basically saying, hey, fear has come out of this market, and even with a little bit of selling yesterday, it's certainly not ramping up. However, this is where things get a little bit more nuanced. If we could pull up the VIX futures curve, which is more of a reflection of how the market's pricing volatility in time, what it looks like is right now maybe we're a little bit complacent, but as you start adding in weeks and months, volatility is getting priced in pretty rapidly. You have a very steep VIX futures curve right now, Sam, which to me says, yeah, maybe we're complacent about what might happen over the next week, next couple weeks, but there's still a fair amount of fear being priced in as you go out in time because there's so much uncertainty still, you know, in the foreground here that we can see, and we just don't know how it's going to play out yet.
Yeah, complacency seems to be the operative word, and Liz Ann Saunders was also describing the market as that a couple of weeks ago to me, particularly ahead of that July 9 deadline, which, as we've seen, has been now pushed out. But no doubt the markets seem to be suggesting that they are comfortable with some of the uncertainty, which is the other sort of word of the month, you could say, as well. Alex, thank you so much. We'll check in with you a bit later. Alex Coffey, appreciate your time.